Hi everyone, welcome back to my channel. Today I want to explore whether there's too much froth in the stock market, so let's take a look. So this article by CNBC, froth in the stock market makes impending correction look almost obvious, Militaback strategist says. So let's have a look at this video and I'll share my thoughts as we watch this video. So let's click play.
Welcome back to Trading Nation. I'm Seema Modi. Records for the S&P 500 and NASDAQ on Thursday as markets continue their relentless march forward in September. But one of our next guests has a warning. A deep correction could be on the horizon. Let's discuss with Matt Maley and Miller Tabak, Gina Sanchez of Lido Advisors and Chantico Global. Matt, you say a correction looks obvious. What are you saying that the market is not?
Well, I mean, one of the things when I say when I use the term obvious, I was really just trying to show how there's a huge amount of froth in the marketplace right now, much like we've seen in other important tops of the market that only became obvious in hindsight. I mean, you look back at 2000, we had investors that were piling, individual investors piling into the markets. We had people who were we had valuations that were off the charts. We had stocks of companies that had no short-term or even long-term fundamental basis for their moves flying through the roof. And of course, the market eventually rolled back over. And we saw the same thing in 2007, 2008, when you had, this time it was the housing market where people were buying buying houses with no money down or just 5% down, no documentation that they had a job or anything like that. And again, we had a market that was overbought, extremely overbought, and extremely expensive. Now we have a very similar situation where you have the stock market where it's the meme stocks, which are flying up, companies with absolutely no, they're not going to change the world. These stocks are going up 2,000% in just a few days. You have the SPACs that have been going crazy here. We have a stock.
I think he's talking about meme stocks like GameStop that went through the roof because of all the traders on Reddit that were making big bucks. He was talking about the 2000s, which is the dot-com crash. Then 2008, the global financial crisis, which was led by banks lending to subprime people, so people that couldn't afford to repay their loan. So he's saying that there's people pouring money into the stock market and it's frothing up the market.
Market that's very, very expensive and a market that's overbought. I mean, you look at the QQQ, it's now at almost 70% premium to its 200-week moving average. That's higher than any of the last three, before any of the last three corrections. Now, again, I'm not trying to compare this and say, oh my gosh, we're about to hit to one of those crazy, really ugly bear markets that we saw in those last two times. I'm just saying there's some froth out there that nobody's going to mention until after the fact. And what I think people should do is raise a little bit of cash. It doesn't mean sell everything. Go to 50% cash or even 20% cash. But if you raise a little bit of cash, you'll be able to buy the stock if it corrects. But more importantly, you won't be selling when the market's down 15 or 20%, when everybody else is selling at the exact wrong time. You'll be the one keeping your head, holding on to your winnings, and be able to take advantage of the market when it goes back up.
I think he makes a valid point to always have some cash on the sidelines. So that then when the market does crash, you've got some money to invest in the market. At the same time, no one knows when the top is. And as you were saying, that the stock market can crash. And it's only with hindsight where you can look back and go, oh yeah, it was too high. And so you can't really predict what the stock market is going to do. But it's a solid advice to say to have some cash on the sidelines to take up any opportunities as they arise.
Gina, a lot to unpack there. Do you agree or disagree with Matt? Are we due for a pullback?
Well, look, I think Matt is making some really important points, particularly about the froth that is happening. And I think that part of what's feeding that excess froth and money that's finding its way into Robinhood stocks, finding its way into SPACs, finding its way into crypto, is a lot of the excess money, the fiscal stimulus, the monetary stimulus, and just the amount of liquidity that's generally sloshing in the economy. And to Matt's point, when you start to get those excessive moves, there is certainly the potential. What I look for is a catalyst. And I see two possible catalysts, Seema, that could actually bring forward some volatility at the least and a correction at the worst. The first catalyst I see is just the fact that we have priced in very strong expectations. You know, we're going to hit huge GDP growth this year. Next year, we're going to have lower GDP growth. Will it still be strong? Yes, but it will be less than now. We priced in enormous earnings growth because we had very weak comps. Now we're going to go into stronger and stronger comps. And we're going to settle and see where the economy is going to be after the pandemic, after the Delta variant, and whatever variant comes after this. And so there is a lot of potential for disappointment now because we've actually hit all those numbers handily, I might add.
So she raises a good point. As the market was going up, it was based on high expectations of earnings and growth numbers. As those numbers have been hit, the returns going forward may not be as great. So therefore, the stock market could pull back when the market doesn't achieve the high expectations that are priced in the stock market.
But at this point, all the comps get harder. So that inflection point tends to be fraught with volatility. I think the second and more important catalyst I'm looking for is when the liquidity starts to get dialed and sucked out of the market. When that happens, I think that's when you could have a real potential correction. That's going to be based on the Fed. It's going to be based on what happens with lending programs. It's going to be based on all of this excess liquidity that has been available that either may not be available or when you get to the other side where you have to start paying that back.
I think the stock market is a bit frothy right now. Central banks with their money stimulus packages and also the government stimulus packages are keeping the economy afloat right now. But as those stimulus packages taper, it could lead into the stock market falling. The stock market is quite high because they're pricing in huge growth numbers in economic growth as well as company earnings. And if these were to reduce a bit, the stock market will fall to reflect the reduction in the earnings. Thank you for watching my video today, and I hope you got a lot out of it. Please don't forget to subscribe, like, and hit the notification bell for future content. Thanks again for watching.